Good morning, everyone. My name is Abraham Jaimez. I am one of the senior associates here at K Properties and Investments. We're going to go ahead and get this call started. Thank you all for joining us on the K Properties 1031 Exchange DST investment webinar. We'll begin with risks and disclosures. DST 1031 properties are only available to accredited investors, generally described as having a net worth of over $1 million, exclusive of primary residence, and accredited entities only, generally described as an entity owned entirely by accredited individuals and/or an entity with gross assets of greater than $5 million. If you are unsure if you are an accredited investor and/or an accredited entity, please verify with your CPA and attorney. The information herein has been prepared for educational purposes only and does not constitute an offer to purchase securities, DST properties, and/or real estate. Such offers are only made through a private placement memorandum, PPM, which is solely available to accredited investors and accredited entities. Securities are offered through FinX, member of FINRA, SIPC. FinX and K Properties are separate entities. This material is not to be interpreted as tax or legal advice. Please speak with your own tax and legal advisors for advice and guidance regarding your particular situation. There are risks associated with investing in real estate and Delaware Statutory Trust, DST, properties, including, but not limited to, loss of entire investment principal, declining market values, tenant vacancies, and illiquidity. Investors should read the PPM carefully before investing, paying special attention to the risk section. Because investors' situations and objectives vary, this information is not intended to indicate suitability for any particular investor. Please speak with your CPA and attorney to determine if an investment in real estate, DST properties, is suitable for your particular situation or circumstances. Past performance is not indicative of future returns. Potential cash flow, returns, appreciation are not guaranteed and could be lower than anticipated. And again, thank you everyone for listening in. And now I'd like to turn the call over to our Senior Vice President here at K Properties and Investments, Matt McFarland.
Thank you very much, Abraham, for the introduction, and to our listeners, thank you very much in advance for your time this morning. We hope that you find this presentation informative. We're going to take a deep dive into, first the 1031 exchange. We're going to then transition into the DST structure. That's where we're going to spend the majority of the time. From there, we're going to transition into looking at a few past examples of what DST properties look like. We're going to dive a little bit into due diligence and then kind of end with talking a little bit about our platform specifically. So really appreciate you being with us. Just to kind of set the foundation, we're going to go over a quick overview of the 1031 exchange. As many of you are familiar with this, the 1031 exchange is a part of the tax code that's been around for over 100 years. And it was initially written in to the tax code back in 1921. And essentially what it allows investors to do is to defer tax on sale of investment real estate. And the IRS leaves it a little bit open-ended with respect to what exactly that constitutes. We're going to dive into more detail on that in just a bit. But really property used for or held for productive use in a trade or business or for investment. So investment property sold and the proceeds traded into another investment property. There's a few requirements that investors need to be aware of. The first on the slide here is very, very important. An investor must use a qualified intermediary. So upon close of escrow, the funds must not go into one's direct possession. If that takes place, the 1031 exchange is blown and all the capital gains tax, depreciation, recapture, all the whole slew of taxes are going to be due. Very, very important. The funds must go through a qualified intermediary who's set up as kind of another escrow. They administer the proceeds from the closing of the relinquished property to the designated replacement properties. Number 2 and 3 have to do with a dollar value. So this is really important. Number 2, 100% of the net proceeds or equity proceeds must be reinvested into the replacement properties. And number 3, the investor must purchase equal or greater value in replacement properties as they had of relinquished property. So this is really important when we're talking about investors who have a debt or a mortgage against the property that they're selling. What number 3 is saying is that not only do investors need to spend 100% of their net equity after they paid off the loan balance, they must also replace the value of the loan that they had against the relinquished property. I want to caveat all this, if you'll pay attention to the top of the slide, this is for full tax deferral, right? This is if investors want to completely defer all of the taxes that they're able to under the 1031 exchange. There is the ability rather to do what's called a partial exchange, where you defer, a portion of the taxes. We're not going to get into that in today's conversation, but just wanted to clarify that as well. Number 4 and 5 have to do with the time periods. Number 4 is what investors struggle with the most, the dreaded or infamous 45-day identification window. An investor has 45 days or roughly 6 weeks to designate their replacement properties. This is designated through a form that is filled out and submitted to their qualified intermediary. And then from there, they'll have an additional 135 days or 180 days in total from the date of close on the relinquished property to formally acquire or close on those properties that they identified. We're going to circle back on the 45 days as we get into the DSTs, as there are some unique advantages there. So here's just a kind of a pictorial representation of the time frame. You see close of escrow, 45 days to identify, 180 days to close. Common misconception, many investors confuse the term like kind. Many investors believe this to refer to the same type of property. So in other words, apartment building for another apartment building. This is not correct. This is incorrect. So like kind refers to the nature or character of the property, in that it must be held for productive use in a trade or business or for investment, does not refer to the type of real estate asset. Really, really important. So a few examples of what this could look like under the 1031 exchange umbrella. An office building can be sold in exchange for an apartment building for raw land for industrial property, single family rental for a duplex, farmland for apartments. And then the last one, any type of investment real estate exchange for a Delaware statutory trust, DST for short, property. And this is where we're going to spend kind of the rest of the time talking about the DSTs in a little bit more detail. So starting with the basics, what is a DST 1031 property? Delaware statutory trust. It's a type of replacement property. It's actually an entity that's used to hold title to investment property that allows for investors to purchase a piece of the property. This has been approved for a 1031 exchange under an IRS revenue ruling that was made back in 2004. That's IRC Revenue Ruling 2004-86. And since then, the DSTs have become the primary passive group ownership format that passive real estate investors turn to or consider rather when completing a 1031 exchange. So as I mentioned, DST, just think of it as any other entity, right? It's a trust that is set up in the state of Delaware. and it's used to hold title to real estate. In many ways, very similar to an LLC or even family living trust. The biggest difference compared to an LLC is that the DST does in fact qualify as like-kind property, where an LLC, a general partnership, a limited partnership, an REIT, these other structures are not approved for 1031 exchange, and would be kind of out of the equation if we're talking specifically about approaching this through the lens of a 1031 exchange. So how does a DST property work with respect to potential distributions or cash flow and appreciation? So when an investor invests into a DST, they are acquiring an undivided beneficial interest of the trust, a trust that holds deed to a piece of property, or sometimes it can be multiple properties. And so as an interest owner, the investors are entitled to their portion of really everything that relates to that property and that trust. So they're going to receive 100% of their potential distributions, 100% of the pro rata portion of potential appreciation, net of closing costs. Once again, this is unlike most other forms of private equity real estate, such as limited partnerships, private REITs, LLCs, funds, where typically in those structures you can have some type of waterfall split, where a large portion of the appreciation is given to the sponsor. Usually this is set up as some sort of preferred return. The DSTs are not set up that way. There is no ability for the DST to share in any of the profits that are generated. So next question, can I do a 1031 exchange out of a DST? The answer is yes. When a DST property is sold, the investors are free to do another 1031 exchange, and they can exchange into any like-kind replacement property. So they could do another DST, they could buy another piece of property that they self-manage. The same process and the same options are available for them in the future. Of course, the investor can also decide to take the cash value and pay the tax at that point as well. Once again, different from other private equity structures, as investors are typically not able to do a 1031 exchange and defer tax when those other structures realize a capital gain. So talking about some of the benefits here, potential benefits in the next few slides, one of the main advantages or main draws for investors is that this is the most passive option that they can consider on the spectrum of passive to active within the realm of what's accessible in a 1031 exchange or for a 1031 exchange. So this is investors saying goodbye to the terrible T's, the tenants, toilets, and trash. The DST properties have professional asset and property management in place. So the investor is very much so in a mailbox money type of position as it relates to their investors. They are not going to be involved in any of the day in or day out management of the asset. They're going to sit back and hopefully receive a consistent distribution stream over 5 to 10 year period of time. They're going to get quarterly reports and updates on the property. They're going to get their tax information furnished for them, and then at one time will be notified that the property is going to be sold, and then get to reevaluate their situation at that point. So this is, once again, these are built for the passive investor, someone who wants to concentrate on other areas of their life besides their real estate. This could be anything from family, travel, other businesses, and really this is a lifestyle change at the end of the day for many of our investors, from a very active management role into a passive role. Another potential advantage is the ability to diversify. So the typical minimums for these investments is as low as $100,000. So what that allows our investors to do is spread their equity across multiple different DSTs. And this can be across DSTs of different property types. So multifamily apartments, industrial, office, medical, triple net, all different types of properties are represented in the DST space. They could also diversify by debt structure. So some DSTs carry debt, some do not. So allows them to diversify across geographical locations, by DST sponsor company. I mean, there's so many different approaches we can take with respect to diversification. I want to highlight at the bottom of the page, diversification, of course, does not guarantee profits and does not guarantee against losses. However, it is a tool or a strategy that we use to eliminate concentration risk into any one particular asset. So talking about taxes, I mentioned this just a few minutes ago, the investor actually will not receive a K-1. They're going to receive an operating statement for the DST. Sometimes this is referred to as a substitute 1099. This information is passed along to the investor's CPA. The CPA will input it to Schedule E of the tax return, just like any other commercial or rental properties. So I mentioned earlier there's multiple different types of properties with respect to financing. The properties that do carry financing allow investors to assume their portion of that financing very easily. And just even taking one step further back, going all the way back to one of the initial slides, if you recall, one of the requirements that the IRS places on 1031 exchange investors is replacing total value. And so that value includes any mortgage value that's paid off at closing. So translate that to kind of a primary acquisition in a 1031 exchange. One of the major risks is always going to be identifying a property that an investor is able to close on, right? And a lot of times for investors who need to replace debt, a part of that acquisition in more of a traditional sense is working with some type of lender and lining up and closing on a loan in advance of being able to acquire a piece of property. So there's a lot of moving parts behind the scenes, and for anyone who's worked with a lender, you know how difficult it could be to get them exactly what they're looking for. So the DST properties make it really easy for this aspect in particular, where not only are the properties already acquired and the due diligence already done, but the financing is already lined up and packaged into the investment. So this really helps investors mitigate a fair amount of closing risk in the process, where they're able to very easily step into and assume their portion of the financing that is typically 100% non-recourse to them. And what that means is that the investors are only liable up to the equity principal that they have invested in that one particular DST. The lender is not able to go after other assets, as the note is set up on the institutional level. So that's another advantage, because most of the time investors don't have the ability to do that if they're lining up financing on their own. So diving into the loan structures a little bit more, if the DST, if the loan on the DST does have an amortizing feature to it, which many of them do, the investors do receive their pro rata portion of the principal paydown. In terms of loan to value percentages, there's quite a big range, but anywhere from 35 up to 60% is typically, what we're dealing with. And as I mentioned too, there are properties that are structured as all cash or debt free, where there's no loans whatsoever. And what's really nice too about the kind of this prepackaged financing is it allows investors to assume exactly the amount of financing that they need to or may want to assume in the process of a 1031 exchange, through being able to allocate specific amounts of their equity to specific DSTs with specific loan to value percentages. And that's another kind of aspect of the diversification capabilities. Is, say there was an investor who only needed a 25% loan to value for their 1031 exchange. That investor can invest half of their equity value into a DST at 50% loan to value. The other half of their equity they can invest into a debt-free or a 0% loan to value. So combined, they're replacing exactly the same amount of debt that they need to replace, but they're only taking on the financing risk in half of their exchange portfolio. So anyways, that's just a quick example, but I think that also highlights the flexibility that the DSTs, especially the leveraged and also all cash DSTs, have to offer. So moving into the all cash debt-free kind of type of DST property, really asking the why question. Why would an investor consider this in the first place? A few of these are going to be really obvious. No refinancing risk, provides the investor the ability to hold through any market downturns, credit crunches, recessions. There's no special provisions built into a loan because there isn't a loan. Some of those can be cross collateralization loan risk, where multiple properties in one DST are all kind of built into one singular loan. And that loan is kind of all encompassing, if you will. No cash flow sweeps. Number two, I think is something important to take a look at. Eliminates the risk of taking on equal or greater debt in future exchanges. So if an investor moves from a debt-free position into a leveraged position, when that leveraged property sells, they're going to need to replace their portion of whatever the financing is that they initially assumed, and their portion of the total value of the financing that was paid off at the eventual close. So by staying debt free, that's not something that the investor has to worry about. Another aspect, the investors do not have to worry about any maturity events as it relates to the loan. Most of these loans have a balloon, maturity event, usually about 10 years from when the loan was initially kind of put together. No prepayment penalties, oftentimes lower fees, sometimes even higher cash flow, especially in today's environment, higher interest rate environment. But really what I want to highlight here is flexibility. When investors stay debt free, they don't have to worry about loans coming due. They don't have the DST company does not have to worry about prepayment penalties if they get a really great offer in a few years and maybe want to capitalize on it. They don't have to worry about these different cash flow sweep triggers. They don't have to worry about refinancing risk, all these other things. And I think for a defensive investor, of course, who has the ability to stay debt free in the first place, this can be a really attractive option for them to try to kind of eliminate financing risk from the equation altogether. So moving more into the basics, or kind of the mechanism, if you will, of how the DST is acquired. So a DST property can be acquired within 3 to 5 business days after submitting subscription documents. So this is another huge advantage too, going back to the tight timeframes that are a part of 1031 exchange in general. The DST properties are pre-packaged real estate investments, right? The real estate's already been acquired, the due diligence has been done, you know, all of the third-party reports, everything has already been done, and it's pre-packaged and it's built for a passive 1031 exchange investor to very quickly and efficiently acquire an interest in the property, take care of their 1031 exchange, start, you know, accruing cash flow right away, and ultimately, you know, move on with their life. So this next section, we're going to be talking about some of the different properties. These are you know, different property types. You can see everything from, you know, multifamily, triple net, healthcare, government lease buildings, leverage, debt-free, zero coupon. But we're gonna, in just a minute, we're gonna go through and actually talk about some of the different examples of real kind of past offerings that we've been a part of over the years. One thing I want to just mention in advance, and Abraham talked about this in the intro, is DST properties are only available to accredited investors and accredited entities. So an accredited investor on the individual level is an individual with a net worth of greater than $1 million, exclusive of their primary residence. An accredited entity is an entity in which all the equity owners of that entity are personally accredited, or the entity itself has assets of over $5 million. We always encourage investors to check with their CPA and attorney just to verify their accreditation status before investing in their DST property, because there is that limitation is set. So moving into some of the examples, I'm going to move through these very quickly. One thing I want to say in advance, all of these happen to be examples of all cash or debt-free properties. K Properties, we do offer many leveraged opportunities as well. For our current opportunities, feel free to visit our website or reach out to your representative. We're happy to get you access to the current listings. So this is a debt-free distribution facility in Winston-Salem, North Carolina. This is leased to FedEx Freight. Here is a debt-free townhome community in Nashville. This is a debt-free pharmacy leased to Walgreens in Phoenix. This is a Frito-Lay distribution facility in Sterling, Virginia. Another FedEx ground in Uvalde, Texas. This is a Fresenius Kidney Care in Atlanta, Georgia. This is a medical testing laboratory leased to CSL Plasma in Chicago. This is a data center in Tacoma, Washington, leased to DaVita. This is an all-cash apartment community in Missoula, Montana. This is an Amazon last mile distribution facility in Akron, Ohio. And I told you I was going to move quickly. So those, like I said, just a few examples. Feel free to reach out to us for some of our current opportunities. Happy to get you set up there. This next section is, you know, kind of going into one of the main aspects that sets K Properties apart from others, and that relates to our due diligence process. So I'm going to kind of go over that, but before we kind of jump in here, one of the main advantages that K Properties brings to the table is experience. So our founders started in the space in 2007. K Properties was founded in 2010. And over the last, 15, 16 years, we have seen pretty much every single DST that's come to market and have been able to kind of track with how certain assets, certain DST companies have performed or not performed over the years. And all of that kind of makes its way into our investment philosophy, which is ultimately kind of the basis of how we go about our due diligence. So just a little bit of background there. But the K Properties due diligence team is comprised of multiple members who have performed due diligence, research, analysis for an array of different real estate companies, both on the national and international kind of scale. In terms of sourcing our data, there's a number of different kind of ways we go about this. Anything from mystery shopping through commercial grade databases or subscriptions, actual property inspections, and then of course all the third party reports that you would go through in kind of the initial due diligence period on the property. Before we even take a look at specific opportunities that are presented to us from different DST companies, there are certain asset classes that we just flat out reject. We find that no matter how you crunch the numbers, there are certain asset types that are too high risk for us to get comfortable with and too high risk for the general DST investor. And this, once again, comes from our experience and witness of over the years speaking to thousands of investors, many of whom who have lost tens of millions of dollars investing into specific types of properties. So just to list a couple: senior care facilities, regional shopping malls, hotels, oil and gas. These are types of properties that we reject outright, period. No matter how good the real estate deal looks, you will not find those on our platform. Number two, mystery shopping. This does not necessarily apply to every single DST property. I'd say more so maybe a multi-family property or where there's more leasing activity. And this is where we will send a representative to essentially approach the property, express interest in maybe leasing a unit, and just kind of get a sense of the general atmosphere there, how they responded to. This is something that would not show up maybe from a number sense in any like third party report, but it's more kind of a personal feel, if you will. We find that important. Part of the mystery shopping, and we'll go through maybe a report a little bit later, but we also will spend the time to inspect some of the different properties as well. And that's when we send a representative to go and photograph and visit the property to make sure it is as advertised. Another component is a sensitivity analysis and stress test. So this allows us to really ascertain worst case scenario for the property and how likely that scenario is, subject to happen or not. And once again, we want to see how potentially stable the property is or how much it can withstand in kind of a worst case scenario. Lease audits. So this is really important for any commercial lease, specifically retail, office, industrial, even medical. Really want to make sure that there is not any unusual characteristic. I was actually talking to an investor earlier today, and he was trying to buy a Dunkin' Donuts property outside of the DST structure, but he was saying they were going through the lease, and there was a provision where in 6 days the parent guarantor can automatically downgrade to another entity that is much less financially viable. So that's just one example, but aspects like that, we really want to make sure that there's nothing that could potentially alter the performance and affect the property's value. Third-party reports and market analysis. This comes in the form of the property appraisal, environmental reports, property condition reports, all the typical kind of third-party reports, if you will, that you would look at when buying, an expensive investment property. So in summary, you can do all the due diligence on bad deals, but in the end, they're still bad deals. Obviously, not every single senior care assisted living deal or hotel deal has led to a negative outcome for investors. That's not what we're saying. What we're saying is we have been witness to so many investors who have lost money investing in these asset types, and that's what we're trying to avoid. Obviously, there's risk with everything, and even the property types that we do represent, they don't always perform 100% according to the initial plan. But through the due diligence and understanding what we're up against, through understanding the investor's situation, being strategic with respect to taking on debt or not taking on debt, and ultimately diversifying, there are very much specific strategies that we can lean on to hopefully eliminate as much risk as we can from the equation. Obviously, there are things that are out of our control. But yeah, really, for us, it's kind of a collective effort that ultimately feeds to investment philosophy. So just to kind of close out the webinar here, I'll breeze through kind of our process, and then at the end, we'll kind of highlight the platform for just a minute. But essentially, there is a lot of collaboration that goes into all of this, starting with an introductory consultation. This is where we seek to understand the investor situation, needs, preferences, requirements, timing, etc., so that we can ultimately develop preliminary recommendations, which is kind of the next stage, followed by secondary assessment, due diligence. This is also where we invite investor feedback as well. We encourage, everyone to meet our team, whether that's in person, virtually, conference call. We're headquartered in Los Angeles. We have offices all across the country, and really value that as part of all of this. And then ultimately, it's working with the investor, leading up to their 1031 exchange, so that ideally within kind of the 45-day window, we have everything kind of wrapped up and the investments made. And it doesn't just stop there. So we really pride ourselves on continued education and communication with our investors, just so that our investors can stay current with respect to the DST industry, the real estate industry, the 1031 market, but also if there's ever a need, if there's ever an update or a question, we pride ourselves on serving, our clients. And really, this is a lifelong relationship for us and many of our investors. So a couple of reasons why investors choose to work with K Properties to purchase their DST investments. Hyper specialization, number one. This is what we do. This is what we've always done. We've chosen to take the path of being very, very specialized in DSTs. Many other firms that can offer DSTs offer more general financial planning. they can sell an array of different investment products. That is not the path that we have chosen to take. We're real estate people through and through. We ultimately look at this from a real estate perspective and lean on many years of experience as it relates to real estate. Number two, team effort. We have a team of professionals all across the country. We approach every individual exchange as a team. We want multiple different eyes and perspectives on each exchange effort. And we find that to be the way that we serve our clients really well. We're picky, right? We talked about this. There's certain properties we refuse to access. There are other properties we have access to that are custom or exclusive to our clients. And that's another way that we differentiate ourselves with respect to access, right? We have access to majority of the general marketplace. We also have access to off-market opportunities. So for investors that want kind of a wide array, if you will, of potential replacement products, K Properties is the place that they come seeking for that. We talked about asset class rejection, mentioned our inventory available on our website, www.kpi1031.com. And we talked about mystery shopping, leveraged and non-leveraged DSTs. And really, I think, the last point here, this is something we've done for a long time, right? Our team members are personally invested in DSTs as part of their own investment strategy. We don't just assist others. This is what we've done and what we will continue to do for a very long time. I mentioned K Properties, founded by Dwight K. We're headquartered in Southern California, Los Angeles, offices in New York City, Washington, D.C., San Diego, San Francisco, Seattle, Boston, and Dallas. We have successfully completed thousands of DST 1031 exchange investments for hundreds and hundreds of clients throughout the U.S. We are a consulting advisory service to 1031 exchange clients, and our team members collectively have over 150 years worth of real estate experience, involved in over $30 billion worth of DST real estate transactions, licensed in all 50 states. We do have client references available throughout the country, relationships with CPAs, attorneys, qualified intermediaries. And last point here, always available to help our clients. Weekends, holidays, we understand the 45-day clock does not stop ticking for anyone. So with that, I just want to say thank you to everyone. Hopefully you found this webinar informative. If there are any more specific questions, I would encourage you to reach out to your K Properties representative. There are many other resources available on our website. But with that, I wish everyone a wonderful rest of your Wednesday, and we look forward to speaking with each of you very soon.